Today, we will be talking about chapter 21, which is the taxes on labor supply. And I also, because I think it's since the quite short chapter, and we are going to skip certain parts of it, time will be left to start a little bit chapter 22 as well. That's my plan. So for this particular chapter, which carries the title of Taxes on Labor Supply, we are reviewing first of all, the theory behind the relationship between taxation and labor supply, and then a little bit look at the evidence about this relationship. And then we are going to be looking at a specific tax policy in the United States about the earned income tax credit, which is basically a tax policy that's designed to promote labor supply for low-income earners. And then we are going to be looking at the tax treatment of childcare, another aspect, tax treatment of childcare and its impact on labor supply. And then we are going to conclude. First of all, again, as usual for all the chapters, the motivating example for this particular chapter comes from an Atlantic country, Iceland, where so the income in 1987, due to a transition to a new tax system, income in 1987 was never taxed. So Iceland overhauled its tax system between 1987 and 88, and there workers basically paid taxes on their 1986 income in 1987 and paid taxes on their 1988 income in 1988. So in a sense, 1987 income was not taxed. You paid taxes based on your 1986 income. It doesn't mean that no one has paid taxes in 1987, but simply they paid taxes based on their 1986 income. And in a sense, since this was announced, prior to 1987, income was realized. The question, a nice question is, did the radical change in the tax burden actually affect workers' labor supply decisions? Okay. And there's a paper by Bianchi et al. In 2001, which looked at this issue and found large effects on labor supply and then also on economic growth. Here is the employment rate, the percentage of potential weeks worked in Iceland. Of course, there was a decreasing trend even before this policy change, but as you see, it spiked in that particular year. Of course, in the paper, if you look at the paper, there is more statistical and econometric support behind this increase. However, just to see the visual evolution of the employment rate over the course of the time and seeing that it spikes in that particular year when the tax system was overhauled, that suggests that, at least that gives you some preliminary evidence that that labor supply responds to tax changes. And on average, the idea was the main result was that on average, each 1% rise in after-tax wages led workers to work about 0.4% more weeks than they had previously. And also the real GDP also lived from an annual growth rate of 4.3 to 8.5%, almost doubled. However, the effects were transitory because in 1988, when you go back to the previous or similar tax system, so to speak, these figures had dropped back to levels comparable to the pre-tax reform levels. But it basically suggests that people respond in terms of labor supply, and the economy responds in terms of the economic growth of the GDP to tax changes, to tax policy changes. Now we are going to be looking at the basic theory behind this. So here, the theoretical framework that we are going to use to assess how income taxes affect labor supply is essentially going to be the same model that we used in the very beginning of the semester, this TANF policy, the effect of cash welfare on labor supply, this temporary assistance. The model that we have used, the theoretical framework, that we have used to evaluate the effect of the temporary assistance of needy families tenant policy on labor supply. And here there is a hypothetical individual, Taylor, trading of consumption against leisure, similar to the TANF framework. Each hour of leisure costs Taylor her wage $15. In a sense, the price of leisure is the wage rate, as you know, $15. And that is why the slope of the budget constraint is 15, minus 15, as we are going to see in the next slide. Of course, if government imposes a 30% income tax rate on wages, the slope of the budget constraint changes. The budget constraint rotates. And then the slope becomes, for example, in that case, the 30% of $15 is $4.50. So 15 minus 450 makes 1050. So the slope changes. And in particular, as you can see, it changes in a counterclockwise way. The blue budget constraint is the budget constraint before the tax. The red budget constraint is the budget constraint after the tax. Okay. So now Taylor, for example, you can also see it like, the y-intercept of the budget constraint drops, because the y-intercept of the budget constraint basically illustrates the situation where Taylor has zero leisure, so spends all the time for work, so therefore can get the maximum amount of consumption. Of course, that goes down because now Taylor is also paying income taxes. The maximum amount of leisure hours doesn't go down because you can enjoy still, even before taxes or after taxes, doesn't matter. You can always enjoy 24 hours of the day for leisure activities. Now here, the change in the slope of the budget constraint. Again, you might remember this income effect, substitution effect discussions from intermediate micro, or even principles of micro. Any change in the slope of the budget constraint creates two effects, income and substitution effect. Remember, the shift of the budget, the parallel shift of the budget constraint only creates an income effect if the slope doesn't change. However, if the slope changes, then there are potentially two effects, income and substitution effects, because the slope is the relative price between consumption and leisure, and if the relative price changes in a particular direction, here the leisure, for example, gets less cheaper when taxes are imposed. The price of leisure goes down, leisure becomes cheaper, so to speak. Because you have to you are going to lose less wages for each additional hour of leisure when the taxes are imposed on wage income. That creates two effects, income and the substitution effect. The substitution effect is the fall in the price of leisure, and then it creates an effect towards less work and more leisure, because in the substitution effect, you substitute away from the more expensive product towards the cheaper product. And the cheaper product here is leisure, therefore you substitute towards leisure and consume more leisure through the substitution effect. And consuming more leisure means supplying less labor automatically, because leisure plus labor adds up to a constant number. On the other hand, when taxes are imposed, there is also an income effect, and in fact a negative income effect, because now for each hour of work you have less income due to the fact that you are paying 30% taxes. So assuming that leisure is a normal good, and that is the assumption, leisure is a normal good. Normal good means less income, less, if for a normal good, when income goes down, you consume less of a normal good. And here, since you are experiencing a negative income effect, you are consuming less leisure. You are going to consume less leisure, and then of course it means you are going to supply more labor. So as you can see now, maybe I can use the annotate function here. So substitution effect implies substitution effect of a tax implies more leisure and less labor, whereas income effect implies less leisure, and more labor supply. Okay, so that's, maybe I can put it to here. Okay, so that's an important issue here. Well, and as you can see, the two effects are opposite signs. One of them reduces labor, the other one increases labor. Okay, then the question is, of course, what is the net effect? You know, which one is stronger? Substitution effect, which reduces labor, or income effect, which increases labor. So the theoretical impact of taxation on labor supply is ambiguous, theoretic. But generally, of course, in economics, and that's also an assumption that you might have made before, generally in economics, we tend to think, not particularly for labor supply decisions, but we tend to think that for any income effect, substitution effect analysis, substitution effect is stronger than the income effect. And if this is the case, if substitution effect in this case indeed is stronger than the income effect, then the labor supply is going to go down after the imposition of new taxes, income taxes. Whether it is really the case or not, we are going to look at the, I can now, sorry, let me close down the annotation. But this one. So whether it is really the case or not, we will be looking out shortly. However, so here, again, like we see, depending on which effect is stronger, whether the income effect is stronger or the substitution effect is stronger, results may be different. For example, in panel A of figure 21.3, we have a situation where the substitution effect is intentionally drawn to be stronger, where from the initial allocation of A, after the imposition of taxes, you go to a new allocation B. As you can see, from A to B, Taylor increases leisure, reduces labor. Okay, you know, increases leisure means that, you know, the leisure is going up from 900 hours to 1,200 hours. It means, you know, labor supply has gone down by 300 hours. So here, taxes reduce labor supply if substitution effect is larger. If income effect is larger, you go from A to C instead, where leisure goes down from 900 to 600 in the amount of 300 hours. And automatically it means that labor supply goes up in the amount of 300 hours. So this is basically the theoretical result. Before we see what happens, you know, on the empirical side, just, you know, a little bit talking about the limitations of the theory here. So, okay, so here, the two issues that limits the generalizability of these results is the constraints on hours work and the overtime payrolls. Because here, you know, theory assumes free adjustment of hours work. Like, for example, in my case, just because, you know, suppose, you know, right now they are talking about increasing income taxes in New York City. Of course, for upper level income levels, I don't think that I'm gonna be earning that much. But anyway, let's say, you know, they increase my income taxes for my income level. I'm not just gonna say just because taxes go up, I cannot say, oh, I'm required to teach a certain number of courses per my contract, 2 per academic year, since I also have administrative duties. But I cannot just say, okay, so they increase taxes, now I'm gonna teach 1 course less. I can't say this because it's in my contract. Okay, so, and, you know, I don't think that it's gonna simply change due to the fact that taxes are going up by a certain percentage. Okay, so I cannot clearly adjust my hours worked, and, you know, I cannot respond to these tax changes. And not everyone can. It's similar to me. Not everyone can respond to labor supply, respond their labor supply accordingly. So that this is one thing. And also, you know, firms may, again, like, you know, similar, related to this, firms may want all workers to work the same hours. Like, for example, at Columbia, you know, 9 to 5 was the, you know, the usual working time before the pandemic, of course, in person. Right now we are working maybe sometimes, you know, 24 hours a day, but that's another story, because of production complementarities. And also, the presence of overtime pay rules make it also difficult to adjust hours at the constant wage. In many jobs, there are hour limits, and adjusting those could also be difficult in practice. Now let's look at that evidence a little bit. I'm not going to cover this, thoroughly, but just to see, what the evidence more or less say about this. Of course, there are tons of empirical work about the effects of tax changes on labor supply. And generally, they separately examine primary and secondary wage earners. And just to define what we mean by primary and secondary earners, primary earners are those among the family members who are the main source of labor income for a household. The secondary earners are workers in the family other than the primary earners. Especially for married couples, for example, husband, wife, depending on their decisions, one of them might be the primary earners, the other one can be the secondary earner, vice versa, or just the opposite. Or sometimes, if your kids are living with you, they may also be contributing to the household income, maybe as a secondary earner. And the general conclusion here is that we have to differentiate between those in terms of the labor supply changes. And generally, the labor supply response to changes in income due to taxation were positive. It means greater income means more labor supply, less income means less labor supply. So if taxes go up, basically, labor supply may go down according to this logic. But of course, the question is also, what is the elasticity? Like, if my income changes by 10%, either going down or going up, doesn't matter. Do I respond with my labor supply to it by more than 10% or by less than 10%? Or maybe by a very tiny amount, maybe like 1%, or maybe by a lot of amount, by 50%. So the elasticity is also important. The percentage change in your labor supply after a percentage change in income due to taxation, for example. And here the idea was, or the result is that the primary earners labor supply elasticity is about 0.1, whereas the secondary earners elasticity is much larger. Much larger means between 0.5 and 1, which suggests that, of course, these are approximate numbers, but which suggests that the response of primary earners is a lot more inelastic compared to the response of the secondary earners. The response of the secondary earners is more elastic than the response of the primary earners, so to speak. Okay. And then there are tons of different evidence here. I'm not going to be going through all. The slides spend a lot of time for describing different evidence here, like cross-sectional linear regression evidence. Generally find labor supply of secondary earners are inelastic, as I mentioned. There is experimental evidence. It is a quasi-experimental evidence, different kinds of evidences all around. But generally, again, I'm just skipping those. Generally, there seems to be a labor supply response to tax changes, labor supply response to income changes, and particularly to income changes through tax changes. But of course, the exact quantified effect, the exact number changes from one study to another, and due to the fact that from one country to another as well, because different studies look at different countries or different episodes or different contexts, because income tax may change, but of course income tax may change using different schemes. We can change, on average, maybe you are increasing income taxes, but it also matters how you increase it, what kind of policy changes you increase it. So but that's that's the average sort of the general result about evidence on this. And of course, they also talk about limitation of the existing studies. One such limitation is that the hours worked is a narrow measure of labor supply, because and of course it's the easiest measurable measure, but maybe more important than the number of hours worked could be effort spent on the job, the occupation or career choice, investment in your human capital. These might all be important considerations. And here's a learn by doing question. So which of these is false concerning on taxes on labor supply? Increases taxes induces a substitution effect which decreases labor. Yes, because it increases leisure and decreases labor. Income effect which increases labor. Yes, that's also true. Studies generally show that the net effect of a change in taxes on labor force participation are negligible. The elasticity of labor supply determines the net effect of a change in tax on labor force participation. D is correct, C is wrong. Because elasticity of labor supply is important, as I said, that's what we mentioned. The A and B are also correct. And studies do not show that net effect of a change in taxes on labor force participation is negligible. It changes from one study to another, but it's, you know, it's not, you cannot just say it's negligible. There is a substantial effect. Now, one interesting policy applied in the United States and is a tax policy that may potentially affect labor supply, and then it's a relevant study to investigate in this regard, is the earned income tax credit policy. I'm sure that many of you have heard about that before, because when you are filing taxes, filling your tax forms, you know, you see this earned income tax credit a lot of times. And it's basically a federal income tax policy that subsidizes the wages of low income earners. Okay, and it has two goals. One is the redistribution of resources to lower income groups. Two is increasing the amount of labor supply supplied by these groups by creating some tax policy incentives for them. It was introduced in 1976 and has grown tremendously over time. Nowadays, the federal government spends about $65 billion annually. And this is the evolution of the money spent on this program in current dollars, of course. It's not in fixed dollars. So here, the 1 billion in 1976 is, I don't know the evolution of the inflation in the United States, but it's much more than 1 billion today in today's terms. But still, as you can see, even if you make up for the price level changes, the positive trend is there. And the government right now spends a substantial amount of money on this policy. Now, the question is, of course, whether there are effects on it. But before that, let's see the background behind the policy. So it's basically a refundable tax credit. And of course, the exact amount depends on your earnings. If you earn too much, you don't qualify for it. If you earn zero, again, you don't qualify for it. So the family income must be larger than zero. And then there is eligibility on the number of kids. For families with more than, or the eligibility depends on the number of kids. For families with more than 2 kids, the maximum earnings should be $53,930. So $53,930. With 2 kids, it's around 50. With 1, it's around 45. With 0, it's about 20,000 or 21,000. And here is basically the benefit structure here, how much you can qualify for depending on your earned income. Earned income is on the x-axis and the earned income tax credit is on the y-axis. So for the first $14,000 of earned income, here the hypothetical individual Stacy receives an earned income tax credit payment of 40 cents per dollar of earnings to a maximum of $5,616. Between 14,000 and 18,000, it's flat in this portion. And then it gradually declines after this threshold level until it reaches 0. Okay. So for the theories conclusion about the impact of the earned income tax credit, it may have impact on 4 distinct groups. First of all, for people not in the labor force at all, who were not working before the policy, it is likely to increase their labor supply because they are now going to qualify. If they work and earn some money, they will be qualifying for earned income tax credit. For people who are already in the labor force, but earn less than this threshold amount over here, depending on the sign of the income and substitution effect, depending on which is stronger, the net effect is going to be ambiguous, but most likely it's going to be positive. For people in between this constant portion or in the declining portion of the earned income tax credit, it will likely reduce their labor supply. So, and in a sense, now the question is, of course, whether this, because remember, the intention of the policy was first redistribution, which is here, but also increasing labor supply. Now, the question is whether the increase in the labor supply for the first 2 groups is going to compensate for the reduction in the labor supply for the remaining 2 groups. And here this is illustrated. This person A is in the first group, doesn't work before the policy because he or she enjoys the maximum amount of leisure. Now he or she works more. The B guy, it's ambiguous depending on the income substitution effect. It can either go to B1 or B2. The B2 involves more leisure, less labor. B1 involves less leisure, more labor. For C and D, the 2 remaining categories, leisure goes up, labor supply goes down. Now, if you look at the evidence now, here, we see that we will see that there are substantial effects. But to see the effects, the economists utilized a change on the structure of the policy in the Tax Reform Act in 1986, which basically allowed the economists to test the effect of the policy by comparing those who were affected by these policy changes in 1986 to those who were not. The changes basically included, it increased the range of the benefits. It included raising the subsidy rate, increasing the maximum rate, and reducing the phase-out rate. And as we see here, it's now a wider range of earnings. So the pre-tax policies is here, and the post-tax policies indicated by the solid lines. A wider range of policy was eligible for the subsidy. Of course, the subsidy levels were different at that time. The earned income was different. It's 1986, almost 30, 35 years ago. And what happened is that after the change in the policy, the earned income tax credit first increased the labor force participation of single mothers. Conditional on working, conditional on that you were already working before the policy, there is no effect on the hours of work. And then on married couples who are likely to earn more, even before the policy, married men's labor supply appears not to respond, but researchers found that a modest reduction in the labor supply of married women. So some decline there. So basically, in summary, all this evidence tells us that policy supports redistribution. Redistribution is always there, but it also doesn't reduce labor supply, or can even be, in a sense, be worth creating some incentives for low-income groups to increase labor supply. Okay, and then there are other studies mentioned here about the effect of this EITC's earned income tax credit policy on single mother labor supply, for example, by this Isa Lightman paper. I'm not going to go into the details here, but and this is an important result over here. Now, of course, even though the successful policies supposedly, it also has some flaws, such as for childless workers, it provides very small benefits. There is no credit increase beyond the second kid. There is a marriage penalty, as it's based on family income or marriage tax, so to speak, as we have discussed earlier. It's a very complex policy, and about 1/7 of eligible people do not participate, and the majority of the recipients hire professionals to help prepare their taxes to basically since it's a complicated policy. And they also lose some income, of course, when they hire professionals to help prepare their taxes. And the learn by doing question here is, theoretically, the effect of the ITC on the overall labor supply is ambiguous, right? Because theoretically, of course, because we said that the third and fourth categories of people, labor supply may go down. And the evidence shows that EITC does not reduce the overall labor supply. So choice A is the correct answer here. One final thing that we are going to discuss is the tax treatment of the childcare, which is also an important issue in terms of the labor supply impact. The childcare, as you know, it's the care provided by someone other than the parents of those kids. And it's basically, it was well over $80 billion annually. And it's basically effectively a tax on parents' labor supply, childcare expenditures. And they potentially reduce labor supply, and childcare subsidies provided by the government may increase labor supply. The thing is that childcare here creates a tax wedge because homework is not taxier, but formal sector work is. If I work home and take care of my kids, I don't need to send my kid to childcare. However, if I work in an office, in a formal sector job where I need to go to my job, I need to leave my kid to a childcare and I need to make the spending. That's why it's basically a tax wedge, because homework is not taxed in that sense. On the other hand, the formal sector work is. And the tax wedge is any difference between pre and post-tax returns to an activity caused by taxes. This is the broadest definition of a tax wedge. And the solution here is taxing homework by imputing earnings and make childcare tax deductible. So imputing home earnings, of course, requires assigning a dollar value to the earnings from work at home. And in a sense, then you are creating an incentive for people to go to formal sector work, to offices. And also, of course, while you are doing that, you are also, if you are making childcare tax deductible, then you will also be creating some financial incentives for them. So make market childcare cost deductible, effectively making both forms of childcare subsidized. And taxation of market work, but not homework here, has created a tax wedge that puts market work at a disadvantage. And there are two ways that policymakers could level the playing field in favor of market work: is tax at homework or deduct childcare expenses, and maybe a combination of the two. Here, basis, you have a pre-tax, pre-childcare earnings $1,000, you pay $600 for childcare costs, and taxes owed if work tax rate is 50%, taxes owed if you are working at home. And the after-tax value of work, after-tax value of home are given here. Of course, here, after-tax value of home is larger. So the incentives are in favor of homework in the base scenario. If you are now providing solutions to this by the imputed taxes on homework or deducting childcare expenses, then you can show that now you are basically making the after-tax value of work more, you are creating favorable incentives in favor of the after-tax value work compared to the after-tax value of homework. Because now 500 is larger than 300, 800 is larger than 600, so you have more incentives to go to a formal sector work. Whereas in the base case scenario, without these two policies, you have more incentive to go for the homework. Okay, and imputing income, deducting tax expenses are not equal, of course. The deduction for child case lowers the tax base. That's also an important consideration that the policymaker should take into account. Of course, that if you have these three choices, you have all of these choices have drawbacks, some drawbacks. The statico, without any imputing income or deducting expenses, it lowers social efficiency by deterring mothers from market work. or parents in general, sometimes fathers as well, of course. Taxing homework makes the most economic sense, but is an administrative nightmare. How are you going to make this imputation? Is quite difficult. Offering subsidies to market work reduces the overall efficiency of the tax system because it lowers the tax base. And the evidence on the effect of childcare costs on maternal labor supply, it really can't correlate labor force participation with childcare costs because those wages are the majority of the childcare costs. But there are some quasi-experimental approaches utilizing kindergarten birthday cutoffs. There's a Quebec subsidy in Canadian province Quebec for childcare, randomly assigned childcare subsidies for some welfare recipients. If you look at the results coming out of these quasi-experimental approaches, there is some clear but moderate elasticities of childcare costs in terms of, in the range of -0.1 to -35. Still, it's a deterrence for labor supply. And that concludes our chapter. And now we are going to be looking at a little bit of chapter 22.